38% of Gen Z banking deposits now go to Chime and digital-first competitors. Your branch strategy just lost another 100 accounts this week, still waiting on that core modernization project. By the end of this video, you'll understand exactly why your cost structure is driving customers away faster than your team can acquire them, and what one executive did to reverse it in 90 days. Here's what most bank executives don't realize. You think the problem is rate competition. You think it's marketing budgets. You think if you could just offer a better mobile app, you'd win back that under 35 demographic. But the real problem is cost. Not your cost. Their cost. The hidden fees, the minimum balances, the overdraft charges, the 3-day hold on mobile deposits. Every friction point in your customer experience exists because your cost structure demands it, and every one of those friction points is a reason your customers are leaving. Let me show you what I mean. Fiserv, Jack Henry, and FIS, the big three core banking providers serving 70% of U.S. banks, were built in an era when account maintenance cost $40 per month, and branches justified that expense. Today, Chime operates at $4 per account annually. Not monthly, annually. That $4 cost structure means they can eliminate minimum balances. They can eliminate overdraft fees. They can process deposits instantly, not because they're generous, because their technology allows them to be profitable without extracting fees at every touch point. Your institution is caught in a legacy cost trap. The core systems powering your operations were designed when human tellers processed every transaction, when statement printing was a monthly expense, when branch real estate was the primary customer acquisition channel. Those systems still carry that cost DNA. And as long as your cost per account stays north of $30 monthly, you'll need fee income to survive. Which means you'll keep charging the exact fees that drive customers to competitors who don't need to charge them. Institutions we work with face this tension every week. They know their fee structure is outdated. They know younger customers won't tolerate it. But their CFO shows them the math. Eliminate those fees without modernizing the underlying cost structure, and the institution becomes unprofitable. So they stay trapped, waiting for the right moment to modernize, watching accounts leave one by one. Let me tell you about one executive who broke that cycle. Patricia Chen sat in her office on a Tuesday morning, tortoiseshell reading glasses in hand, staring at a deposit report that confirmed what she'd been avoiding for months. Her community bank had lost 400 accounts in the under 35 segment in the previous quarter alone. Not to the bank across the street. To Chime. To Current. To Varo. Every exit interview said the same thing. Fees. Holds. Friction. Her first instinct was to propose eliminating overdraft fees. Her CFO shut it down in under 5 minutes. Those fees generated $1.2 million annually. Eliminate them without changing anything else, and they'd be operating at a loss within 2 quarters. That's when Marcus Holloway walked into her office, tablet in hand, showing her something she hadn't considered. Not fee elimination, cost restructure. He pulled up a dashboard comparing her institution's cost per transaction against a digital-first competitor. Her wire transfers, 45 minutes of staff time, $12 in. System costs, $25 charged to customers. Chime's wire equivalent, automated, 90 seconds, $2 in infrastructure cost, free to customers. The gap wasn't just about being nice to customers, it was about fundamental infrastructure efficiency. Marcus showed her the real cost buried in her monthly statements. Every account maintenance function still touched 3 different systems. Her platform ran on a Jack Henry core from 2014. Solid technology, but built for a different era. Adding new features required vendor customization projects that took 9 months and cost 6 figures. Her digital banking layer sat on top like a band-aid, trying to deliver modern experiences, while the underlying infrastructure still processed things the old way. Patricia adjusted her glasses. That tell she always had when a new idea was taking shape. What if we didn't try to eliminate fees first? What if we eliminated the costs that make those fees necessary? They started with one workflow. Digital deposits. Under the old system, a customer mobile deposit triggered a 48-hour hold because the core system needed time to verify funds and manage risk manually. That hold period frustrated younger customers who'd experienced instant deposits elsewhere, but eliminating it seemed impossible until they integrated a modern risk analytics layer that could assess and clear deposits in real time. Cost to implement, $80,000. Time to deploy, 6 weeks. The results hit within 30 days. Average deposit hold time dropped from 48 hours to 4 hours for established customers, instant for low-risk deposits. Customer complaints about holds, down 62%. New account openings in the under 30 demographic, up 18%. Not because they ran a marketing campaign, because customers started telling their friends about a community bank that actually competed with Chime on experience. Patricia didn't stop there. She pulled her leadership team together and mapped every customer touchpoint that existed because of legacy cost structure. Overdraft fees, necessary because real-time balance tracking wasn't possible. Minimum balance requirements, necessary because account maintenance was expensive. Statement fees, necessary because paper processing had real costs. Then they worked backward. What would it take to eliminate the cost, not just the fee? They integrated real-time payment rails. They automated statement delivery and made paper opt-in instead of default. They deployed AI-powered customer service for routine inquiries that previously required phone calls to overworked staff. 90 days after that first conversation with Marcus, Patricia's institution had reduced cost per account by 41%. Not by cutting staff, by eliminating the redundant processes that made their staff inefficient. And with that cost reduction, they could finally afford to compete on fee structure. They eliminated overdraft fees for account holders who opted into alerts. They dropped minimum balance requirements for customers under 30. They made mobile deposits instant for anyone with 6 months of account history. The CFO who'd blocked fee elimination 3 months earlier stood up in the board meeting and showed the new math. Lower cost per account meant they could operate profitably at lower fee income. And lower fees meant customer acquisition cost dropped because retention improved and referrals increased. Within 6 months, account growth in the under 35 segment turned positive for the first time in 3 years. Here's what you need to do this week. Don't start with fees. Start with cost. Pull your operations team together and map one customer workflow from beginning to end. Pick something painful. Loan origination, account opening, digital payments, wire transfers. Count every system it touches. Count every manual step. Count every delay that exists because your infrastructure requires it. Then ask one question. What would it cost to eliminate the most expensive step in this workflow? Not optimize it. Eliminate it. You'll find that the cost of modernization is almost always lower than the annual cost of continuing to operate the old way. That's your business case. That's your starting point. If you're running loan operations, this is where platforms like Abrigo prove their value. Purpose-built loan origination systems that collapse weeks of manual workflow into days of automated processing. The cost savings don't just improve your bottom line. They let you compete on speed and experience. The institutions winning right now aren't the ones with the biggest marketing budgets. They're the ones who've restructured their cost base to compete without needing fee income to survive. Chime captured 38% of under 35 deposits because their cost structure lets them offer what yours can't. But that advantage isn't permanent. It's just math. And math can be rewritten. The cost of waiting is higher than you think. The next video proves it.